Welcome to The Explainer. Today we're going on an incredible journey together. We're going to take you from being an absolute stock market beginner all the way to mastering advanced multi-time frame trading systems. There's a ton of ground to cover as we build this comprehensive basic to advanced guide, and we're going to completely strip away the myths to get right down to the hard truths. Okay, let's dive into this. So here is our roadmap for today. We're starting with 1, the stark reality, then moving to 2, market basics and mechanics, 3, the cost of ignorance, 4, advanced trading psychology, and finally wrapping up with 5, the triple screen system. Think of this as our guide. We're going to start off slow with the basics, so don't worry, and then we'll culminate in those high-level advanced strategies. All right, Section 1, the stark reality. You know, the stock market is so often sold as this glittering dream of easy money. But the harsh, unglamorous reality, it's way more ruthless. And honestly, accepting that is your very first step to surviving. So why do 90% of traders fail? I mean, it's a massive number, right? A lot of people jump in assuming, hey, if someone is losing money, someone else is making it, so why couldn't that winner be me? But surviving this game requires completely challenging those preconceived notions about getting rich quick. It really all comes down to this staggering statistic known in the industry as the 90-90 rule. It states that 90% of all traders will lose 90% of their capital in their very first 90 days of trading. Crazy, right? To put that into perspective for a second, imagine 250 brand new traders entering the market today. Fast forward 5 years, and 245 of them will have washed out entirely, never to return. Out of all 250, only one highly skilled individual will ultimately end up taking the money from the other 245 over those 5 years. Which brings us to Section 2, market basics and mechanics. So how on earth do you become that one surviving trader? Well, to survive the 90-90 rule, you first have to strip the market down to its absolute core. Basically, the stock market exists so companies can raise money. When a business needs capital to grow, they can take out a loan, or they can sell shares of their actual company to the public. When they do this for the very first time, it's called an initial public offering, or an IPO. And once that happens, those shares get listed on exchanges, like the NSE or BSE in India, where everyday buyers and sellers can trade them. Now, what's really interesting about this slide is the hidden trap that catches almost every beginner, and that's liquidity and the bid-ask spread. When you trade highly liquid assets, the difference between what a buyer will pay and a seller will accept, that's the spread. It's tiny. We're talking maybe 10 paise. But in illiquid markets, that spread widens dangerously. In fact, there's a true story of a trader who was actually up in profit trading Havells stock options. But because it was an incredibly illiquid market, when he executed a market order to close out, the lack of buyers meant his order filled at a drastically lower price. He literally turned a winning trade into a loss in seconds, just because the spread was a massive 8 rupees. If that bid-ask spread concept still feels kind of abstract, let's think about it like real estate. Imagine you want a house worth 1 crore rupees. You really need to sell it, but the only buyer around is offering 90 lakhs. Because there's literally no one else buying, meaning super low liquidity, you have to just take that 10 lakh hit to sell the place. That 10 lakh difference, that is your spread. In the stock market, trading illiquid assets is exactly like trying to sell a house in a ghost town. And that is exactly why understanding market depth is absolutely crucial before you risk a single rupee. Let's move on to Section 3, the cost of ignorance. Understanding liquidity is just one piece of the puzzle, right? So let's pivot from theory to reality and look at 2 extreme beginner mistakes. First up, we have the gambler. This is a true story about a father about 15 years ago who was trading the commodity market on an old Nokia phone. The software only showed the raw price, no charts, no candlesticks, nothing. He was trading with heavy leverage and was completely ignorant of market structure. On the flip side, we have the blind follower. This was a novice who opened an account and just let a broker execute advisory calls without even knowing what call or put options actually were. As we're going to see, lacking basic technical and mechanical knowledge is just a recipe for absolute disaster. And the fallout from those mistakes? It's pretty visceral. The gambler, trading that commodity leverage totally blind, lost 10 lakh rupees overnight. It was a loss so severe he actually had to take out massive loans just to survive it. Then you have the blind follower. He funded a brand new account with 1 lakh rupees, which was his entire monthly salary, in May of 2015. By 3:20 p.m. the very next day, a single advisory call from his broker had wiped out 50,000 rupees. Literally half the account, gone in hours. Guys, this is exactly what happens when you treat the market like a casino instead of getting an education. Okay, Section 4, Advanced Trading Psychology. Sometimes hitting rock bottom is the catalyst you need, but to actually start scaling your capital,
you have to realize that successful trading psychology is completely counterintuitive to human nature. I mean, novices get nervous and cut their winning trades super early just to lock in a tiny profit, but then they'll stubbornly hold on to their losing trades, just praying they bounce back. A pro does the exact opposite. Back in November 2017, a pro trader took a position in Titan. It gapped up massively, hitting a high of 820 before pulling way back down to 780. Any novice would have panicked and sold the pullback. But the pro, he held the position through the entire month, letting the winner ride for exponential gains, because he knew that the real key to wealth is capturing that massive upside. Because they let those winners ride, pros actually don't need to be right all the time. In fact, if you look at data collected from thousands of actual profitable traders, practically none of them have an accuracy rate over 50%. This completely shocks most beginners who totally fixate on trying to be right 80 or 90% of the time. But in reality, most highly profitable futures and options traders are sitting at a win rate of around 40%, or honestly, even less. So you're probably wondering, how on earth do they make money if they're losing 60% of the time? Well, it all comes down to this ratio, 3 to 1. That's their risk-reward ratio. So the crucial point is, when their stop loss gets hit, they exit immediately, taking a very small, controlled loss. But when they catch a big trend, they hold on to it until it pays out 3, 4, or even 5 times what they initially risked. You can absolutely afford to lose far more often than you win, just as long as your winners are exponentially larger than your losers. And that brings us to Section 5, the triple screen system. To achieve that kind of consistency, you absolutely cannot rely on your gut feeling. You need a rock-solid method like the triple screen system. It's an advanced execution strategy that totally removes dangerous intuition from the equation. Inspired by Dr. Alexander Elder, this method is a really neat 3-step systematic approach. Step 1. You look at the monthly chart to identify the big picture, structural trend. Is the overall market moving up? Step 2. You drop down to the weekly chart and just wait patiently for an oversold condition within that larger uptrend. And finally, Step 3. You drop down again to the daily chart and wait for a tactical confirmation, like a bullish harami or maybe a pin bar candle, to signal your exact entry point. And this brilliantly illustrates how professional traders actually scale their operations. A novice usually tries to make more money by randomly upping their quantity on a single stock, which takes on massive, unnecessary risk. But true pros, they scale their watch list instead. Think about it. If you have a strict system, like the triple screen, and you're only watching 3 stocks, you might be waiting months for a perfect setup. And that leads to boredom, which leads to bad, forced trades. But if you track 30 or 40 different global instruments, you wait organically. You just let the setups come to you across a huge universe of assets, only striking when they meet your exact criteria. So this brings us to a final, really important thought. Trading is not a game of luck. It's a highly refined business of risk management and systematic execution. I want you to take a hard look at your own approach right now. Are you relying on intuition, just kind of hoping to get lucky? Or are you ready to start treating the market like a disciplined, scalable system? The mechanics are out there waiting to be mastered, so what's your next trade going to be? Thanks so much for joining me on this explainer, and as always, keep learning.